Picture this. You enter a trade. Everything looks right. The level was clean. The setup made sense. And then, nothing happened. The price stalled, slowed down, or maybe even reversed. And you're left wondering, what did I miss? Most of the time, the chart already showed you what you missed. You just didn't know where to look. Most beginners think price tells the entire story, but price only shows the direction in which it is going. To get the full story, you need to know whether traders are actually participating in that move. That's where volume comes in. The price tells you where the market is moving in that moment. Volume tells you how much conviction is behind that move. Chart whisperers don't act on movement alone. They wait to see if the move has any real support before putting capital at risk. In this lesson, you will learn how Chart Whisperer uses volume to tell the difference between strong moves and weak ones. You do not need complicated tools and special indicators. You only need to understand how participation works in the market. Volume is simply the number of shares traded during a time period represented by a candle. High volume means many traders are currently buying and selling. Low volume means very few traders are engaging with that price movement. There is no mystery here. Volume shows you how many market participants agree with the current price move. One of the biggest frustrations beginners experience is seeing price move in their direction, entering the trade, and then watching it stall. That usually happens when price moves without support. When participation is weak, moves often fade. When participation increases, moves tend to continue more in that direction. But beginners often make mistakes with volume. The first mistake is ignoring volume completely. Many traders focus only on price or indicators and forget to ask whether participation is increasing or fading. Before entering any trade, pause and look at the volume bars. If they're fading, the move may not continue. Another mistake is in assuming high volume always means price will go up. High volume can also indicate strong selling pressure. The key is to look at how the candle closes. Strong closes accompanied by high volume indicate that there is a good chance of continuation. Volume tells you how much effort in terms of participants showed up. Candles tell you what that effort accomplished. When you compare both to what just happened, you can see whether the market is building or losing momentum. Volume becomes especially important during breakouts and fakeouts. Many beginners get trapped buying breakouts that fail because participation never arrived. Strong breakouts often attract attention from larger traders and institutions, and that attention usually appears as increasing volume. If price breaks a level quietly, that is a warning sign. Weak breakouts often turn into fakeouts or failed moves. Volume is also helpful during pullbacks. In healthy trends, pullbacks usually happen on lower volume. That tells you the move against the trend is weaker. When volume increases sharply during a pullback in price, it can signal that the trend may be losing strength. Strong trends push with participation and pull back with less interest. Volume also becomes more important at key decision levels such as support, resistance, VWAP, and trend lines. These are places where traders make decisions. Higher volume at these levels means more participation is involved in that decision. Lower volume may mean the level is less significant. Volume helps you understand where decisions actually matter. There is also a timing element to volume. Volume is not evenly distributed throughout the trading day. It is usually strongest near the market open and again near the close. Midday trading can often become quiet and slow. Many beginners make the mistake of forcing trades during these low volume periods. Low participation often leads to unusual, choppy price action and unreliable movement. Another mistake beginners make is chasing spikes in volume. Sometimes traders see a sudden surge in volume and rush right into the trade. But if price has already moved far away from structure, that volume spike may mean you are too late. Volume is most useful when price appears ready to break through critical price levels, not after the move has already extended. Here is something about volume that beginners rarely learn. Volume does not only help you enter trades, it also helps you better manage and exit them. Imagine you enter a trade and price begins moving in your favor. As the move continues, you may notice volume increasing sharply while price struggles to move higher. That combination can signal exhaustion. Large participation without continued price progress often means the market is no longer accepting higher prices as easily. That can be a warning that the move may be slowing down. Volume can also show when momentum is fading. If a move begins with strong volume, but the volume gradually declines while price moves sideways, interest may be fading. That may be a time to tighten capital exposure or consider exiting the trade. Volume can also help you stay in good trades longer. If price pulls back slightly but volume drops during the pullback, it suggests that selling pressure is weaker. Many beginners panic and exit these trades too early, but low participation pullbacks often mean the trend is still healthy. However, low volume can create another problem that beginners rarely expect. Sometimes low volume can trap you in a trade. If you enter a stock when participation is very thin, there may not be enough buyers or sellers to move the price efficiently. The chart may begin drifting sideways with small movements and very little activity. When you try to exit, there may not be enough orders available at your price. That means you may have to wait, accept a worse price, or watch the trade slowly move against you while the likelihood of getting out remains weak. This is one reason Chart Whisperer prefers trading when participation is healthy. When volume is present, trades move more smoothly and exits are easier to execute. When volume disappears, the market becomes sticky and unpredictable. In other words, volume does not just help you find trades, it helps you avoid getting stuck in them. There is also a common capital exposure mistake related to volume. When volume looks strong, beginners often feel confident and increase their position size. But volume does not remove uncertainty. Even strong setups can fail. Volume improves probability, not certainty. Your capital exposure rules must remain consistent regardless of how strong the volume appears. Confidence should come from rules, not volume bars. So how does Chart Whisperer actually use volume? The process is simple. We call it the Chart Whisperer 4-step volume check. First, identify the important price level. That could be support, resistance, VWAP, or a trend area. Second, watch how price behaves at that level. Third, compare the current volume to recent candles. Fourth, check how the candle closes. Only then do you decide whether the move shows meaningful participation. Volume supports decisions. It does not make them. When used correctly, volume helps you avoid weak trades and stay in stronger ones. When used incorrectly, it encourages chasing and overconfidence. The difference is not the indicator. The difference is discipline. Volume helps reveal whether price movement is supported by real participation. You do not need to master volume perfectly. You only need to respect what it is showing you. Because when you start reading participation instead of reacting to price, something changes. You stop guessing, and you start making decisions with control, and that's what this is really about. Not catching every move, not being right every time, but staying in control of your capital and your future. Because the chart isn't something to chase, it's something to listen to. If this helped you see the market more clearly, subscribe to Chart Whisperer. This channel isn't about fast money or perfect trades, it's about understanding how the market actually behaves. So you can make calm, structured decisions when it matters most. And if you want to go deeper, start with the next video. Because the more clearly you learn to read the chart, the less the market controls you. And the more control you gain over your time, your decisions, and your future.